you look at history and see what's happened every time we've had an all-time high, it's shocking to see that we've actually done better a year later from an all-time high than the average day. And so there's a little chart that Michael pulled up looking at the last 10 times this happened, and we're now on number 11 where we had a bear market, and then looking at what happened a year later. So with the stats that you pulled up, what did that tell us?
So on average, from the time you hit an all-time high after a bear market, a year later the market's up over 16% over a 1 year period. If you stretch out even further and look at 5 years, on average up 58%, over 10 years on average up 206%. So historically, when you hit an all-time high, the expected return actually goes up. So another chart that we'll pull up on the screen now shows compared to any day, if you invested money at an all-time high, how has that money performed over a 1, 3, 5 year period? So on average, over a 1 year period, when you're investing at all-time highs, the market's up 14.6% over the next year, 50% over the next 3 years, and 78% over the next 5 years. Now, nobody knows what's going to happen in the short term. Market can always go down, and that is unpredictable. But what we do know is if we lengthen the time horizon, if we invest money that we know is truly long-term money that we're not going to need tomorrow, the odds are actually in our favor historically by investing.
Other big thing I'd point out is when you just see the market, that's talking about the S&P 500, which is 505 companies, and it's market weighted. So the biggest companies have the biggest impact, and there's several companies at the very top that are up a bunch, but a whole lot of the other companies are actually not done well lately, and down. In fact, when you look at small cap growth, it's down 15%. So even though the S&P is at an all-time high, a lot of that's at the very top of the S&P, and our portfolios have diversification. So we own some small cap growth that's down. Large cap growth was up the most last year, up a ton, and so as we just rebalanced last week, we were taking money from large cap growth and adding to small cap growth and the other pieces of the pie that are down. So is it a bad time to buy when we're an all-time high? No. There's a great book we both read, just keep buying. And that kind of synopsizes my philosophy on it is, when should you invest money? When you have it. When should you sell investments? When you need it. So absolutely, just keep buying. And these couple charts that Michael's done homework on and pulled up here kind of show the numbers.
The last thing that I'll point out is I think looking at 2022 and 2023, what happened with large cap growth and large cap value over those periods does a good job of demonstrating the value of rebalancing. So if we rewind to 2022, large cap value maintained its value for the most part. It was down a few percentage points. Large cap growth, on the other hand, it really got hit in 2022. So the market as a whole was down about 15%. Large cap growth was down closer to 30. If we move forward to 2023, the opposite happened. So large cap growth was up close to 50%. Large cap value was up, but not nearly as much as the market. So a good rebalancing strategy had you buying more of large cap growth when it was significantly down, selling some of large cap value to fund those purchases. And then 2023, we were selling some of that large cap growth that was way up, using the proceeds to buy some of the large cap value that was not up as much.
Absolutely.